is Bazaar Morning Call, live from the CNBC-TV18 headquarters in Mumbai.
Good morning, welcome to Bazaar Morning Call. I'm Lata and Anuj and Surabhi joining me from their respective homes. Well, actually, it looks like the market will stay with its range and look for a direction. The cues are extremely confusing. We don't have a unidirectional cue. The global markets, if you look at Wall Street, ended with some flourish, breaking a three-day jinx and ending 1.6% higher on the Dow. But Dow futures are not keeping up that trend. So Dow up, but Dow futures down. If you look at India, then the second package was perhaps more underwhelming than the first. The first one had a solid 3 lakh crore package for MSMEs, which banks have taken to with some enthusiasm. The next one, about 1.6 lakh crore, again by way of farm loans, that is Kisan credit card loans, as well as probably some employment generation for tribals and loans for street vendors, looks much less likely to be accomplished because a given list of street vendors or the likelihood of more Kisans, using the Kisan credit card at a time when, there isn't so much of work in rural areas, looks a little unlikely. And therefore, this about 1.6 lakh crore of impact that the second package is making looks less likely to happen. It is very clear now that if you look only by the impact of the first package, second package, and the Reserve Bank steps, about 18 lakh crore of impact is already in the bag. So we should perhaps not expect too much from the remaining three packages. The market may want to factor that in. And in that case, the lower end of the range, the 9,000 to 9,500 approximate range, is more in danger than the higher level, I would think. But Anuj, I leave that to you. Good morning. How is the market positioned?
Good morning, Lata. Well, you know what? Yesterday evening, the bears were jumping because the SGX Nifty was below 9,000. But, that doesn't matter, right? We had that sharp recovery in the US market. That's a big relief. The main reason of the market decline yesterday was this two-day fall in the US market. And not just that the US markets rallied, but the VIX fell. So I think that is a bit of a comforting sign, though, as you said, the futures are down marginally. So it's not conclusive yet. We'll find out. The market fall yesterday was essentially ETF-driven large cap selling. If you just see the stats, FI sold about 2,100 crores, and you take a look at the large stocks. 4 stocks accounted for 65% of Nifty's fall: Reliance, HDFC Twins, and Infosys. And if you see the delivery numbers in these 4 stocks, that was 2,700 crores. FI sold about 2,100 crores. So what you had essentially yesterday was a bit of an India sell call on large stocks taken by ETFs. And that's why the mid caps didn't do too badly. The mid cap index on a day like yesterday could have easily fallen about 2%, but that was flat, and advanced decline was about 2:3. The point I'm trying to drive home here is that it was essentially a large cap selling, and overall market was not as bad as the index suggested. However, there is selling in large caps, and you can't ignore that, and the selling in index futures as well. Yesterday, in fact, there's an interesting data. If you see the index futures, FI sold quite aggressively, 1,300 crores. And not only was there unwinding of 7,000 longs, there was a buildup of 12,000 shorts. Now, the issue with short buildup is that can be cushion for the market if the market holds to a support mark. This data has to be looked at in that context. So while the texture of the market is now sell on rally, can the market trap shorts at some point? We'll find out. The big hope for the bulls really would be if yesterday's low is held. If yesterday's low is held, these shorts will have to cover. But if you start to break yesterday's low, then obviously there's going to be a bit of a problem. I think, again, I would say one thing: observe the first hour of the market and then take a call accordingly in which direction you want to trade, because this is a market which has been trapping you on both sides for last couple of days, or last 1 week rather. So it'll be good morning.
Good morning, Anuj. Good morning, Lata. Yes, and talk about trapping. I mean, I was looking at the screen right now, and Asia has actually slipped to the lowest level of the day, and we had the SGX Nifty up at least, some minor, a little close to the flat line. Now the color is red across most of the Asian markets, including the SGX Nifty for now. And Dow futures are now down 100 points after the 300-point overnight rally. So it's very volatile. An additional cue to perhaps keep in mind is the big cash selling that we got yesterday in the market. It was about 2,100 crores. That's how much foreign investors sold out. So it's really all over the place. Crude is an added worry point perhaps for the Indian market today because of this 9% rebound that we saw in prices. Inventories, US inventories were up for the first time in 15 weeks. Though, of course, the demand projections are still very weak. But that's something to look out for. And so far, we're halfway down the month. Where are we? So just a recap of the numbers. We're down 7% on the Nifty for the month of May. And we are down so far about 1% for this week. But Anuj, given what you said that, it's very muddled and global markets themselves seem to be lacking clear direction, where does it leave us? We had the expiry get over yesterday. So for now, is this market still managing to hold on to a range?
I think the market is still holding on to the range, Surabhi. It will need 2 or 3 things to break this range completely, which is that you'll need a complete collapse in global markets and perhaps some negative news out of India. As of now, that's not happened. But like you said, Asian markets as well, the texture of the market globally in emerging markets has become a bit of a sell-on rally, and especially in the bigger stocks. So that texture is intact. But is the market going to break that range decisively? Look, on a closing basis, the market has already broken the month low. The May low has already been broken on a closing basis on the Nifty. What you have now is the day of the Prime Minister's speech, when before that you had that sharp intraday fall. I think we've slipped even below 9100 and were in the danger of breaking 9000. I think that becomes perhaps sacrosanct. But yes, the market's texture has become weak. That I think nobody should have any doubt about.
Okay, so that's the market setup. But Lata, before we start off with the calls, I want to get your views. This week has been all about getting in the stimulus, getting in the package. So from the 20 lakh crores, first we got the 6 lakh crore announcement. Yesterday, a lot of steps more for the agri side and for migrant laborers. Where does it leave us on the micros and the hope of some help in the restart?
Well, it's very clear that the government is worried that rating agencies may not look kindly to blowing up the fisc. So the bigger borrowing program has already been announced, perhaps to make up for the tax shortfall. Maybe a small sliver of that is for macroeconomic push, but it's not a great deal. If you looked at the first package, which was very good, I thought, the MSME package and a little bit for NBFC, that's all guarantees. None of them will hit the fisc now. They will hit the fisc if any of those loans default, and government will have to pay that money to the banks. But most of them are 4-year loans, so it's not happening even next year. The total damage to the fisc was about 16,000 crores. And the current package, perhaps the damage to the fisc is even less, because most of it is in the form of grains or loans to street vendors and Kisan credit cards. So the impact on the fisc at the most is about 30,000 crores. And if you add that to the March package, which included some money transferred to Jan Dhan accounts, then you even then don't get more than 1% of GDP. You probably get less than that, maybe 0.7, 0.8. So a person looking at the Indian economy is very clear that there is no fiscal stimulus possible. The manner, if the government's past actions are any guide, it shows that it is not willing to go down the path of fiscal push. It wants banks to give that push. And I am not so sure that banks, which have become the victim of bad loans, for almost last 5 years, will have the courage now to go ahead and give loans. And these are all micro loans. Even if these are given, it's not really a very big push. So if you were under the impression that there is a large rural package which will help FMCGs, no, nothing of that sort is coming. There is no large transfer of income. So the macro economy is not getting any support. Fringes are getting support, but we will have to learn to live with that, which is why, Anuj, I was a little worried. If the rally was, moving to a higher range was on that 20 lakh crore promise, that will start getting dwindled down, because there is no 20 lakh crore fiscal stimulus. It's very, very marginal in terms of the economy push. And that's why I'm worried that 9,000 could be in danger, because there is no fiscal stimulus. But anyway, we'll wait and see. There are 3 more packages. There's one today and on Saturday and Sunday as well. So we could live in hope. With that, we move over to equity advice that's coming in today. Comes from Andrew Garthwaite of Credit Suisse. Andrew Garthwaite says they are structurally overweight growth in Europe and the US on a 2 to 5 year view. The fall in Treasury inflation protected securities, they're called TIPS securities, or the TIPS yield, should re-rate long duration assets, and growth can re-rate to the levels seen during previous growth bubbles.
Okay, let's move to the money market call, starting with the currency. First up, Bhaskar Panda of HDFC Bank says the central government announced some more measures to address migrant labor woes and many more measures. Given this background, he expects the USD INR to trade in an intraday range of 75.40 to 75.60.
And with that, let's get to Bhaskar Panda's view on bonds. Bhaskar says Indian government spend is going to be considerably higher. Yields had moved up because of that. It could stabilize at realistic levels as rate cut hopes have started emerging. Hence, the new benchmark 10-year bond yield could trade within a range of 5.75 to 5.85. Okay, and with that, let's go into our first break. Thereafter, we're going to invite our entire research team to tell us the stocks that they are watching.
Your medical doubts?